Imagine waking up tomorrow and discovering that every dollar you thought you had quietly lost a few cents overnight. Not because of a market crash, not because of a bad investment, not because of anything you did wrong, but simply because the system was designed that way. Imagine realizing that no matter how hard you work, how carefully you budget, how responsibly you save, the value you thought you were building erodes a little more every single day. It doesn't ask for your permission. It doesn't wait for your paycheck. It just happens, quietly, relentlessly, like a leak in the ceiling you don't spot until the entire roof collapses. And the wild part? Most people don't even notice it. They shrug it off. They tell themselves it's temporary. They assume things will go back to normal. But here's the truth. Inflation never really left. Even when news headlines talked about it slowing down, retreating, cooling off, whatever soft, friendly word they used, your wallet didn't feel any better, did it? The price of groceries didn't suddenly drop. Rent didn't magically rewind. Utilities didn't offer a discount. And your paycheck? That definitely didn't stretch any further. Before we dive in, a quick disclaimer. This video is for educational purposes only and is not financial advice. Always do your own research and talk to a licensed professional before making financial decisions. Now, let's talk about why ignoring inflation is one of the most expensive mistakes everyday Americans make. Not because they don't care, but because inflation is engineered to be invisible until it's too late. It doesn't show up like a thief breaking into your house. It operates more like termites, quietly destroying the foundation while everything looks fine on the surface. The narrative that inflation is gone or under control is comforting, but comfort is often the enemy of truth. Inflation is not a switch you turn off, it's an echo. Even when the rate slows down, the higher prices don't simply fall, they get locked in. If a gallon of milk jumps from $2.50 to $4 during a period of high inflation, slowing inflation doesn't send it back down to $2.50. Slowing inflation simply means the next jump might be to $4.10 instead of $4.50. The climb continues, just at a calmer pace. The average person hears inflation fell to 3% and thinks, oh good, things are getting cheaper. They're not. They're getting more expensive, just a little slower than before. And without understanding this, people walk around with false confidence, believing the worst is behind them when in reality, the consequences are still unfolding in real time. Think back to the last few years. Food prices up, rent up, cars up, insurance, both auto and home, up dramatically. Utility bills up, service costs up, even streaming subscriptions quietly crept upward. Now consider this. If inflation hits 6% one year, 4% the next, 3% after that, you don't get a refund. You just get a permanently more expensive life. But the problem goes deeper than rising prices. Inflation changes behavior of consumers, businesses, and even governments. And that behavioral shift is where everyday Americans lose the most. When inflation becomes a regular part of economic life, people stop saving because what's the point? They spend faster, take on more debt, or fall into financial patterns that trap them for years. Businesses, meanwhile, preemptively raise prices, not because they need to yet, but because they assume costs will rise. It becomes a self-fulfilling cycle. And where does that leave the average household? Struggling to catch up to something that keeps moving faster than they can. Let's look at paychecks. Wages in the US have risen, yes, but not at the same pace as costs. When the government says wages are up 4%, but groceries are up 20% over 3 years, rent is up 25%, and utilities are up 15%, that 4% increase is actually a net loss. Imagine racing someone who's sprinting while you're jogging. Even if you jog a little faster each year, you're still falling behind. This is why many Americans feel poor even if they technically earn more than they did before. They are not imagining it. They are not bad with money. They're dealing with an economic environment where even doing everything right still feels like losing. And then comes savings. Inflation punishes savers more than almost anyone else. If you keep $10,000 in a bank account earning next to nothing while inflation hovers at 3 to 5%, your money is essentially shrinking every year. It's the equivalent of trying to fill a bucket that has a hole in the bottom. No matter how much water you pour in, the level never seems to rise. Retirees feel it the hardest. Their income is fixed. Prices are not. So what ends up happening? They cut back. They downgrade. They stretch prescriptions. They postpone medical appointments. They live smaller lives even after decades of work. But here's the piece most people never think about. Inflation doesn't just raise the price of things, it redistributes wealth. The people who benefit are those who own assets, real estate, stocks, businesses, commodities. These things adjust with inflation or even exceed it. The people who lose are those who rely on cash, fixed income, or wages, those whose wealth depends on the stability of the dollar. Inflation rewards owners and punishes workers. It rewards debtors and punishes savers. It rewards those who can raise prices and punishes those who can't. That's why ignoring inflation is dangerous. It's not just an economic concept, it's a transfer of power, a reshaping of who gets ahead and who stays stuck. And every year that passes without understanding this dynamic is another year where the average household cedes ground without realizing it. And there's another silent consequence: financial stress. When basic costs rise faster than income, people don't only lose money, they lose a sense of stability. They worry more, they argue more, they delay life decisions, they avoid risks they once would have taken. Inflation doesn't just shrink wallets, it shrinks confidence, it shrinks opportunity, it shrinks the margin for error. And when the margin for error gets smaller, life becomes more fragile. Meanwhile, corporations have mastered the art of hiding inflation in plain sight, not just through price increases, but through shrinkflation, selling less product for the same price, or by adding fees, or reducing quality, or creating subscription models that lock people into recurring payments that quietly rise. You're not paying for more, you're paying for less more often.
And it's working. Because most consumers don't have the time or mental bandwidth to track every subtle change. They're too busy working, managing families, surviving. Which means companies get away with replacing a 16-ounce package with a 14-ounce one, and most people won't notice until months later, if ever. All of this creates a dangerous illusion. On the surface, things look stable enough. Stores are stocked, jobs exist, the economy isn't collapsing, but underneath, purchasing power is eroding. Debt levels are climbing, savings rates are falling, and Americans, for the first time in modern history, report needing more than ever just to feel comfortable. Inflation is like gravity. You don't see it, but you feel its effects everywhere. It pulls down the value of money. It drags on household finances. It weighs heavily on anyone trying to move upward. So if inflation is still here, still affecting everything, still shaping the financial lives of millions, why do people ignore it? One reason? Fatigue. After years of hearing about inflation, people get numb. It becomes background noise. And when something becomes background noise, it becomes easier to overlook, even if it's still harming you. Another reason? Optimism bias. People want to believe things will get better. They want to believe prices will come back down, even though historically they almost never do. It's human nature. Hope feels better than reality. But the biggest reason is this. Inflation doesn't feel like a sudden emergency. It's slow, gradual, like rising water. You don't realize how deep you are until you're struggling to breathe. The danger is not just inflation itself, it's the complacency it creates. Because when people stop paying attention, they stop adapting. They stop optimizing their finances. They stop seeking opportunities. They stop defending their purchasing power. And the system counts on that. That's why understanding inflation is one of the most important financial skills a person can have today. Not to panic, not to live in fear, but to live with awareness, to recognize the signs, to make adjustments early instead of late, to protect themselves in ways most people never think about until the pain is unavoidable. Ignoring inflation is not harmless. It costs families thousands. It delays goals by years. It rewrites financial plans. It quietly widens the gap between those who know how money works and those who simply hope everything will turn out fine. But once you see what's really happening, you can start reclaiming control. You can start making decisions not based on fear, but on clarity. You can start aligning your money with reality instead of wishful thinking. And you can start pushing back against a system built to reward those who understand it and to take from those who don't. Before we move on, remember, this is not financial advice. This is for educational purposes only. Understanding inflation isn't just about knowing that prices rise, it's about recognizing the ripple effects that move through the economy long after the headlines fade. And one of the most significant, yet least talked about consequences is how inflation rewires the psychology of spending, saving, and investing. Because once people believe that money today is worth more than money tomorrow, behavior changes in ways that can make inflation even worse. Think about what happens when people lose confidence in the purchasing power of their dollar. They stop waiting for prices to come down. They stop delaying purchases. They feel pressure to buy sooner rather than later, because waiting only guarantees paying more. And when millions of people behave this way at once, demand spikes. Businesses see this increased spending and feel justified raising prices again. That's how inflation becomes self-sustaining. Not because of the initial cause, but because of the collective reaction to it. For some households, this creates a cycle of reactionary spending. Buying bulk before prices rise, purchasing durable goods earlier than planned, grabbing opportunities impulsively out of fear. It turns normal financial decisions into emotional ones. This behavior disproportionately hurts families with lower incomes because every decision becomes heavier. A mistake is costlier. A delay is riskier. A miscalculation can snowball. At the same time, credit becomes more attractive, even if it's more dangerous. When inflation is high, borrowing feels like a discount. If inflation sits at 5%, but someone takes out a loan at 3%, that loan is effectively cheaper over time. But this logic only works in theory. In reality, most consumers don't get the low-interest loans corporations and wealthy individuals do. They get credit cards at 20% APR, car notes at inflated rates, or personal loans with high fees. They borrow thinking it will help them outrun inflation, but the debt grows faster than the problem they were trying to solve. Inflation has an uncanny way of amplifying existing financial weaknesses. If someone already struggles with budgeting, inflation makes it worse. If someone is living paycheck to paycheck, inflation widens that gap. If someone is barely keeping up with their bills, inflation doesn't just push them behind, it forces them into choices that build more vulnerability. And while some households try to tighten spending, many others have no spending left to tighten. The most troubling part is inflation never hits all categories equally. Some rise slowly, others rise explosively. The essentials, food, shelter, transportation, tend to rise the fastest. Luxury goods may even fall in price for a while because wealthier consumers have flexibility. But the basics, the things everyday people can't avoid, climb relentlessly. That's why inflation feels like a middle-class tax. It extracts the most from the people who have no choice but to pay.
Nowhere is this clearer than in the housing market. When inflation rises, home prices usually rise with it. And when interest rates increase to fight inflation, monthly payments shoot even higher. So buyers lose in both directions. The home itself costs more, and the financing costs more. Meanwhile, renters face landlords raising prices yearly because market rates justify it, even if nothing about the rental improved. Most renters aren't paying for better service or better conditions. They're simply paying the inflation tax. And it doesn't stop at housing. Insurance premiums rise because replacement costs rise, medical bills increase because supply chains tighten, used car prices climbed because new car production fluctuated. You feel inflation every time you shop for groceries, fill your gas tank, renew your insurance, or pay a bill. It becomes a part of everyday life, not through dramatic spikes, but through dozens of small increases that blend together like background static. But one of the most misunderstood consequences of inflation is hidden inside businesses themselves. Companies don't simply react to inflation, they anticipate it. This anticipation leads to something called price stickiness, where companies raise prices because they expect their costs to rise later. It's like charging a higher ticket price today because you think tomorrow will be more expensive. The irony is that these preemptive price increases actually help cause the future inflation they fear. And here's the twist. Many companies raise prices not only to maintain profit margins, but to expand them. Research has shown that in certain inflationary periods, corporate profits actually increase faster than costs. Why? Because inflation becomes a convenient shield. Instead of saying, we want more profit, companies say, inflation forced us to raise prices. Consumers, already exhausted by the constant economic pressure, accept it. They assume it's unavoidable. And corporations quietly benefit. This is how inflation becomes less of an economic phenomenon and more of a subtle restructuring of wealth. The people who own assets, stocks, real estate, equity, stay afloat or even benefit. The people who rely solely on wages sink gradually. The people who live paycheck to paycheck sink rapidly. But here's where things start to shift. Ignoring inflation isn't just dangerous for households, it's dangerous for the entire economy. When inflation persists long enough, trust begins to erode. People stop believing that the dollar is stable. They stop believing that the system protects them. And once confidence breaks, momentum builds. Inflation thrives on complacency, but it accelerates when panic enters the picture. This is why economic historians always emphasize the psychology of inflation. It's not about the number the government reports. It's about how people feel. If people feel prices rising faster than they can keep up, they behave cautiously, even fearfully. And when fear spreads, spending patterns shift in unpredictable ways. One of the most overlooked consequences is that people begin to withdraw from long-term planning. Retirement? Hard to think about when groceries keep rising. Saving? Hard to do when rent absorbs every spare dollar. Investing? Hard to justify when you're not sure how long your job will last or how high living costs will climb. Inflation, when ignored, doesn't just damage financial stability, it damages financial vision. It turns long-term thinking into short-term survival. Even those who understand inflation often underestimate its cumulative impact. A 3% annual inflation rate doesn't sound like much, but over 20 years, it cuts the value of money nearly in half. Think about that. The savings someone spent decades building gradually erode, not because of bad choices, but because the currency itself slowly dissolves. Yet then comes an even deeper layer. Inflation quietly alters social mobility. When prices rise faster than wages, upward mobility becomes harder. When essential costs consume most of a person's income, saving for emergencies becomes a luxury. When saving becomes a luxury, investing becomes virtually impossible. And without investing, wealth does not grow, it stagnates. This is how inflation traps generations. The effects compound. Children grow up in households with less stability. Families delay milestones, homeownership, education, marriage, children, because the financial foundation never feels solid enough. Inflation isn't just a number on a chart. It's a force that shapes lives, decisions, and futures. And yet, despite all this, a large percentage of people still choose to ignore inflation because acknowledging it feels overwhelming. It feels like facing a storm without an umbrella. Most people prefer not to think about it. They rely on hope, belief, or habit. They assume the system will correct itself. They assume things eventually stabilize. But stability is not automatic. It's intentional. It requires awareness, adaptation, and action. Because inflation punishes those who stand still and rewards those who move. So the real question becomes, what can everyday people do? They can't control the economy, they can't control interest rates, they can't control global supply chains, but they can control their understanding. They can control how they prepare, they can control how they position themselves. A person who understands inflation is already ahead of someone who doesn't, even if they both earn the same income. Knowledge doesn't magically fix the economy, but it changes decisions, small decisions that compound over time.
And by understanding how inflation shapes the financial landscape, people can begin identifying patterns, opportunities, and pitfalls. They can stop being passive participants and start becoming active strategists in their own financial lives. Because inflation, while powerful, is not unbeatable, but it is unforgiving to those who ignore it.
This is why recognizing inflation matters, not just to economists, not just to investors, not just to businesses, but to families, students, retirees, workers, everyone. Inflation touches every corner of life, and the more invisible it becomes, the more dangerous it becomes. Because at the end of the day, inflation is not just about rising prices. It's about what rising prices do to people, how they alter confidence, behavior, opportunity, and future planning. It reshapes priorities, it forces adjustments, it drives uncertainty. And yet, despite its power, inflation is not some mysterious force. It's understandable, it's predictable in many ways, and most importantly, it's survivable with awareness. The people who thrive during inflationary periods aren't the ones with the most money. They're the ones with the clearest perception, the ones who see the shifts early, the ones who understand the rules of the game even as the game changes. And that's the turning point. Inflation becomes far less threatening once you understand how it works, how it moves, how it influences everything from corporate strategy to household budgets. Because knowledge turns the invisible into the visible. And once you see inflation clearly, you're no longer reacting in fear, you're planning with purpose. When people start to understand how quietly inflation shapes their financial lives, they also begin to notice something else. Not everyone experiences inflation the same way. Two families earning the same income can feel inflation completely differently, depending on what their expenses look like, where they live, and how much flexibility they have in their budgets. And this difference, this gap between how inflation feels and how it's measured, creates confusion that leaves many people even more vulnerable. Official inflation numbers are averages. They're meant to capture broad economic price movements across many categories. But people don't live in averages. They live in specifics. They feel the price of groceries, not the price of luxury handbags. They feel rent increases, not the cost of airline tickets. They feel the rising price of electricity, not the cost of recreational goods. So when officials say inflation is easing, but the grocery bill tells a completely different story, people feel gaslit by the numbers. This disconnect leads to frustration. It leads to mistrust. And that mistrust has real consequences. When people stop believing official inflation reports, they start relying solely on their personal experience. And personal experience, while important, is narrow. It sees inflation in the categories where a household spends the most money, but it misses broader trends. That's how people end up feeling trapped, helpless, or overwhelmed, unable to differentiate between short-term spikes and long-term structural changes. This emotional reaction creates another silent danger, adapting too slowly. Because when people feel the system doesn't reflect their reality, they disengage from financial conversations. They tune out. They stop paying attention. They assume nothing they do will matter. Inflation thrives in that mental environment, where clarity fades and resignation grows. But there's an even deeper layer to this problem. Inflation disproportionately affects those who spend most of their income on necessities. The person who spends 50% of their income on rent and groceries will feel inflation far more intensely than someone who spends 10% of their income on the same essentials. So even if the official inflation number is 3%, the lived inflation rate for lower income households can feel like 10% or more. That's why inflation has been called the most regressive invisible tax. It hits hardest at the bottom and least at the top. But while inflation exposes economic divisions, it also reveals something else: the extraordinary fragility of personal financial systems built on tight margins. For decades, many households have relied on predictability. They budgeted around stable grocery prices, stable rent, predictable utility bills, and steady wages. Inflation disrupts all of that. It removes stability from the equation. It forces households into constant financial recalibration, and that recalibration comes with emotional exhaustion. The human mind craves certainty. It craves stability. It wants to believe that next month will look like this month. But inflation takes that comfort away. And when uncertainty becomes the norm, people lose long-term focus.
They begin reacting to each price increase individually, instead of recognizing the broader pattern. They adjust their habits in small, fragmented ways instead of strategic ones. They sacrifice things that matter in favor of things that feel urgent. And over time, this creates a sense of financial drift, where life becomes more about coping than improving. But understanding inflation isn't just about dealing with higher prices. It's about understanding why the system is built this way in the first place. Inflation is not an accident. It's not a mistake. It's a feature of the economic system. And one of the reasons inflation persists is because the economy relies on a certain amount of it. A little inflation encourages spending. It encourages borrowing. It encourages investment. It prevents deflation, which can freeze economies. That's why governments and central banks target a small amount of inflation rather than zero. But the problem begins when that small amount becomes larger, faster, or longer lasting than expected. And when inflation accelerates, the stability that the system depends on begins to crack. Governments struggle to balance support with discipline. Businesses try to protect margins. Workers demand higher wages. Households stretch themselves thinner. Everyone adapts, but not everyone adapts equally. A household with savings can absorb rising prices for a while. A household with investments can keep pace with inflation or even stay ahead of it. A household with property sees the value of their home rise. But a household living on wages alone absorbs inflation full force. A household in debt feels inflation twice, through rising living costs and rising interest rates. A household without savings feels inflation immediately, with no buffer. This is where something called the inflation lag effect comes into play. Inflation doesn't hit everyone at the same moment. It hits those with the least financial insulation first and hardest. It spreads slowly from sector to sector, from household to household. Some people feel the pressure early, others feel it months later. And by the time the broader economy recognizes the impact, the damage to vulnerable households is already deep.
But inflation doesn't only affect people based on income levels. It affects them based on life stage. Young adults entering the workforce feel inflation through rising rent and cost of living. Families with children feel it through education, food, and healthcare. Middle-aged workers feel it through rising home insurance, maintenance costs, and saving responsibilities. Retirees feel it through shrinking purchasing power and fixed incomes. Everyone experiences inflation differently, but everyone experiences it. The deeper question then becomes, how do people protect themselves? The answer starts with awareness, but awareness alone is not enough. To adapt effectively, people need to understand how inflation interacts with every aspect of their financial life: income, expenses, debt, savings, assets, and long-term goals. Ignoring any one of these creates vulnerabilities. Income is the first pillar affected. When inflation rises faster than wages, real income falls. But most people don't think in real income. They think in dollars. So when they see a slightly higher paycheck, they feel progress, even if that progress is an illusion. Understanding real income means comparing wage growth to cost of living growth. Only then can a person truly assess whether they are moving forward or falling behind. Expenses are the most visible pillar, but they're also the easiest to misinterpret. People often focus on one or two categories, food and gas, for example, while ignoring others that rise more slowly but compound over time. Someone who only tracks grocery prices may underestimate their total inflation exposure. Someone who only watches rent may miss rising service costs. Inflation requires holistic awareness. Focusing on one category while ignoring others creates blind spots. Debt becomes a double-edged sword during inflation. In theory, inflation reduces the real value of fixed-rate debt. But for most people, debt is not fixed rate. Credit cards, adjustable loans, variable-rate financial products, they all increase alongside inflation-fighting interest rate hikes. That's why many households end up paying more in interest during inflationary periods, even if their debt amount doesn't change. The cost of borrowing rises even if the balance stays the same. Savings suffers in the quietest way. A person may believe they're being responsible by keeping money in a low-interest savings account, but inflation eats away at that money in the background.
The value decreases even if the number stays the same. And because the loss is invisible, people underestimate it. They don't feel the pain immediately, so they don't adjust their behavior. Only years later do they realize how much purchasing power they've lost. Assets, on the other hand, can provide protection, but only if a household has access to them. Real estate typically appreciates with inflation. Stocks often rise in nominal terms. Commodities sometimes surge, but households without the capital to invest remain stuck. Inflation widens the gap between asset owners and non-owners because asset values rise while cash holds steady or shrink. Long-term planning becomes the hardest hit. Inflation destroys predictability. It makes future numbers uncertain. A retirement goal that once seemed achievable becomes unclear. A savings plan that once matched expenses becomes inadequate. A family planning for college suddenly faces tuition rising faster than income. Inflation pushes long-term goals further away. This is why ignoring inflation is not just a financial mistake, it's a strategic one. It allows people to drift without realizing how much ground they're losing. It gives inflation more power than it deserves. But once people understand the mechanics, the psychology, the ripple effects, and the long-term consequences, they can begin to regain control. They can identify the pressure points in their finances. They can recognize which areas demand urgent adjustment. They can stop reacting emotionally to every small price increase and start responding intelligently to the broader pattern. Because the truth is this: inflation is not a storm that passes, it's a climate. And in a changing climate, the people who thrive are not the ones who hope it gets better. They're the ones who adapt to the conditions and move with purpose. As people begin to recognize how inflation affects each piece of their financial lives, something shifts. They start to see patterns they hadn't noticed before. Patterns that were always there but were hidden beneath routine, habit, and the assumption that things will eventually settle down. And one of the most revealing patterns is how inflation changes the value of time itself. Time is one of the most underestimated elements of personal finance. People talk endlessly about money, budgets, opportunities, and investments, but they rarely talk about how inflation reshapes the meaning of time. In a stable economy, time is an ally. It compounds savings, it strengthens investments, it makes long-term planning predictable. But under inflation, time can turn into an adversary. It erodes savings, it disrupts compounding. It forces people to make decisions sooner than they would like to. It puts pressure on every financial move. Consider the simple act of saving for a major purchase. In a low inflation environment, someone can take their time. They can slowly build up their savings knowing that the price will remain relatively stable. But under inflation, the longer they wait, the more expensive the item becomes. The delay itself becomes a cost. And if their savings grow slower than the price increases, they may never catch up. The same dynamic applies to retirement planning. Inflation means that every year the cost of retirement rises. A person who thinks they need $1 million today might need $1.5 million a few years from now. Not because their lifestyle changed, but because the purchasing power of the dollar changed. And if their investments aren't growing at a rate that keeps pace with inflation, they're losing ground even if their account balance grows. Time doesn't just become less helpful, it becomes a silent threat. Even emergency funds are affected. A $10,000 emergency fund may have felt sufficient 5 years ago. But if the cost of living has increased significantly since then, that same emergency fund covers fewer months of expenses. Yet many people treat their emergency fund as a static number, not a dynamic one.
Once people internalize this, they start looking at time differently. They realize that waiting carries risk, inaction carries a hidden cost, and that the longer inflation persists, the more the value of procrastination grows. This changes the way people approach goals. Suddenly, long-term plans become urgent, future decisions become present ones, and the question shifts from "can I afford to do this" to "can I afford to wait?" But inflation doesn't only transform the value of time, it transforms the definition of stability. In the past, stability meant steady income, predictable bills, and consistent prices. It meant a household could plan without worrying about sudden increases in their cost of living. Inflation breaks that model. Stability becomes something you have to create, not something the economy provides. Households start seeking stability in new ways. Some seek it through multiple income streams. Others seek it through fixed-rate debts that protect them from future rate hikes. Some look for stability through hard assets. Others through skill building, hoping that increased earning potential will shield them from rising costs. Inflation forces people to reassess where true stability comes from. But what becomes clear is that traditional financial advice, things like save a little each month, avoid debt, stick to your budget, doesn't fully account for inflation's impact. These pieces of advice were built for a different era, one where prices rose slowly and predictably. Inflation changes the stakes. It demands updated strategies. It demands more awareness, more adaptability, and more intentional planning. For example, the idea of saving money in a traditional savings account becomes less effective during inflationary periods, not because saving is bad, but because the value lost to inflation outpaces the value gained through interest. Yet many people cling to the idea that saving alone will protect them. They don't realize that inflation is eroding their safety cushion in real time. Budgeting also becomes more complicated. A budget created in January may be outdated by July if prices rise significantly. Households must revise their budgets more frequently. They must stay aware of trends instead of assuming their expenses will stay similar throughout the year. The idea of a set it and forget it budget becomes unrealistic. Even debt management shifts. While avoiding high-interest debt is always wise, inflation changes the nature of certain types of debt. Fixed-rate mortgage holders, for example, benefit because their payments stay the same while the value of their home rises. But those with variable-rate loans may see their payments spike unexpectedly. Inflation makes the type of debt someone carries just as important as the amount. Then there's investing. Inflation makes investing not just an option, but a necessity for many households to preserve purchasing power over time. But investing requires a level of confidence and knowledge that inflation undermines. When people feel financially strained, investing feels risky. When prices rise faster than wages, people feel they can't afford to invest. Inflation creates a psychological barrier that keeps many people from taking the very steps that would help them. This is the irony of inflation. It punishes those who hesitate, yet creates conditions that make hesitation feel safer. Another pattern becomes clear as inflation reveals itself. Households begin making trade-offs that don't align with their values, but with their limitations. Families cut back on experiences, delay vacations, postpone life milestones, push aside hobbies, and minimize discretionary spending. Over time, these adjustments don't just change financial habits, they change lifestyle identity. Inflation gradually reshapes how people live, not in dramatic, sudden ways, but in quiet, incremental shifts. A family that used to eat out once a week now does so once a month. A couple that planned to buy a home puts the plan on indefinite hold. A parent who wanted to save for their child's education realizes the numbers no longer add up. These compromises accumulate. Each one feels small, but together they create a life that looks different than the one people envisioned. And this is why understanding inflation matters so much. Not because people should obsess over every price increase, but because inflation influences life trajectory. It affects choices, opportunities, comfort, and security. When ignored, it silently redirects financial paths without people realizing it. But inflation also reveals something hopeful, something empowering. It shows that there are ways to adapt, to strengthen, to navigate, even in an unpredictable environment. People who understand inflation begin to see where the real leverage points are in their financial lives. They begin seeing which decisions create more resilience, which habits protect against uncertainty, and which strategies reduce vulnerability. They start recognizing that the best defense against inflation isn't panic, not cutting everything, not living in fear, and not trying to predict the future. The best defense is flexibility, the ability to adapt quickly, the willingness to update plans, the discipline to stay informed, the courage to make difficult adjustments before they become forced choices.
people also realize that inflation encourages a new level of intentionality. It forces questions that should have been asked all along. What expenses truly matter? What is worth paying for? Where does value come from? Which financial habits serve long-term goals and which only offer the illusion of security?
Inflation brings clarity because it removes the comfort of assumptions. It makes people more selective, more thoughtful, more deliberate. It reshapes priorities in ways that often lead to stronger financial awareness. But perhaps the greatest insight inflation offers is this: financial resilience is not about having the most money. It's about understanding the forces that influence money and responding instead of reacting. Inflation is one of those forces. It is powerful, but it is not random. It is intimidating, but it is not unstoppable. It is inconvenient, but it is not insurmountable. And the people who come out ahead are not the ones unaffected by inflation. They are the ones who refuse to ignore it. They pay attention, they adapt, they make informed decisions rather than emotional ones. They understand that inflation isn't an enemy to fear, but a condition to manage. And in managing it, they gain more control over their financial future than they ever had before. That's the part almost no one talks about. The way inflation quietly reshapes not only people's budgets, but their expectations, their tolerance for financial pressure, and even the way they plan for the future. When you expand that out across an entire population, the effect becomes massive. If millions of people are gradually adjusting to less, then what looks like a temporary economic challenge evolves into a generational shift in spending, saving, and risk-taking. And the real problem is that by the time most people recognize what's happening, the damage is already baked in. The lost years of financial progress, the unrealized investments, the delayed life milestones, these things don't just bounce back because inflation eventually cools off. They linger. And that's exactly why ignoring inflation or treating it like a minor inconvenience ends up being one of the costliest decisions everyday Americans can make. Because the truth is this: inflation doesn't need to be high to hurt you. It just has to be higher than the rate at which you're improving your financial position. If your income doesn't grow faster than prices, if your savings don't earn returns above inflation, if your debt becomes more expensive while your dollars become weaker, then even low, steady inflation is eroding your stability. People imagine inflation as some explosive, dramatic spike, but the real threat is when it becomes normal, when it settles into the background and slowly grinds down your options while you're too busy working, surviving, or raising a family to notice what you're losing. Think about the typical American right now, working longer hours or juggling multiple side gigs, not because they're chasing luxury, but just trying to maintain the same standard of living they had a few years ago. There's this unspoken lie that if you just work harder, everything will balance out. But that's not how the math works. You can't outwork inflation. You can't outwork the shrinking value of your money. If your purchasing power falls 10% and your wage goes up 3%, you're not catching up. You're falling farther behind, just more slowly than before. And that gap is where debt thrives. That gap is where financial stress grows. That gap is where people make desperate decisions like skipping retirement contributions, delaying healthcare, taking higher interest loans, or ignoring long-term planning altogether. But the silent danger becomes even clearer when you zoom in on something most people don't consider. Inflation compounds. Just like investing, just like credit card interest, inflation builds on itself. If you lose 5% of your purchasing power this year and another 3% next year, that's not just an 8% loss. It's a compounding reduction in how far your money goes. That's why ignoring inflation isn't neutral. It actively multiplies the damage. And everyday Americans feel it most in the areas they can least afford to compromise: food, housing, healthcare, transportation. These aren't optional categories. They're survival-level expenses. When those rise while wages lag, inflation forces people into a corner. And once you're in that corner, it's incredibly hard to climb your way back out. But this is where it gets even more concerning. Inflation widens the wealth gap automatically. Even without any new policies, even without any major market shifts, inflation naturally pushes wealth toward people who own assets and pulls it away from those who don't. If you have real estate, stocks, businesses, inflation often boosts the value of what you already own.
If you don't have those things, inflation just makes everything you want harder to reach. So the ladder of wealth gets steeper while the bottom rungs get farther apart. And that's how entire generations can end up locked out of wealth building opportunities, not because they're lazy or irresponsible, but because inflation quietly moved the finish line every single year they weren't looking. And the truth is, most people can't look. They don't have the luxury to analyze CPI reports or track macroeconomic trends or compare inflation-adjusted wages. They're exhausted and overwhelmed. And that's exactly why inflation becomes more dangerous when ignored. Because the less attention people pay, the more economic room inflation has to rearrange their lives. When you don't know something is eating away at your financial foundation, you can't reinforce it. You can't protect it. And that's what inflation counts on: invisibility. It doesn't need to crash the economy to hurt you. It just needs to blend into the background. But here's the part that's rarely discussed. Ignoring inflation doesn't just affect your money. It affects your decisions. People start playing defense. They become hesitant to invest. They avoid making long-term commitments. They choose the safe route, even when it's the route that actually costs them more in the long run. Fear replaces strategy. Short-term survival replaces long-term growth. And once an entire population starts behaving that way, the effects ripple outward. Businesses invest less, innovation slows down, productivity decreases, economic mobility declines. Inflation creates uncertainty, and uncertainty discourages progress. Yet there's something every person needs to understand. Inflation is not unbeatable. It's not a death sentence for your financial life, but you do have to acknowledge it, and more importantly, you have to adapt to it. Because the people who do adapt, the people who understand how inflation works and how to position themselves, are the ones who end up significantly better off than those who pretend inflation doesn't matter. And that gap grows wider every year. The first key is understanding that cash by itself is not a strategy. Holding large amounts of money in a savings account is like trying to store ice on a hot summer day. It may feel safe, but it's melting whether you watch it or not. That doesn't mean cash is useless. You need liquidity for emergencies, for stability, for flexibility. But relying on cash as the primary vehicle for your financial future is one of the biggest ways inflation drains your potential. The goal is to balance your safety with growth. That growth doesn't require extreme risk or complicated investments, but it does require awareness.
Another key principle is this: you have to increase the value of your time. When inflation rises, the cost of your hours rises too. If your income isn't growing through raises, skill development, side income, or entrepreneurial opportunities, then inflation is effectively discounting your labor. And the market rewards scarcity. Skills that are common get punished by inflation, while scarce skills often outperform it. That's why paying attention to inflation isn't just about money, it's about career strategy, adaptability, and upward mobility. And then there's debt. Inflation interacts with debt in a way most people never consider. High-interest debt becomes even more dangerous when inflation is high because the real cost of repaying it increases as your purchasing power falls. Meanwhile, certain forms of low-interest debt can actually become cheaper in inflationary periods. The difference between these two scenarios can determine whether inflation becomes a burden or an advantage in your financial life. But you can only make the right moves if you're aware of how inflation affects the math behind your decisions. At the core of all of this is a simple but powerful truth. Inflation punishes passivity. It punishes inattention. It punishes people who assume that the economy will fix itself while they focus on other parts of life. That doesn't mean you need to obsess over it. You just need to acknowledge it and protect yourself against it. Because no one else is going to do that for you. Not your employer, not the government, not the market. The burden falls on individuals, and the sooner people accept that responsibility, the better prepared they become. But here's the hopeful part. When you understand inflation, even at a basic level, you start seeing opportunities that most people miss. You start noticing trends earlier. You recognize when something is becoming overpriced. You learn how to stretch your money further without sacrificing quality. You become more strategic with your time, your skills, your purchases, your investments. Inflation becomes something you manage instead of something that manages you. And that's why conversations like this matter. Not because fear is useful, but because awareness is.
Ignoring inflation is a luxury people can't afford anymore. The days of assuming the economy will normalize are over. The world has changed, and so have the financial rules that govern it. The people who adapt early will feel the least pain later. The ones who stay informed will make the smartest moves, and the ones who take inflation seriously, even when it's not making headlines, will build a level of financial resilience that others may never achieve. As we wrap up this full breakdown, there's one last reminder that needs to be said clearly. This entire video is for educational purposes only and is not financial advice. Your situation is unique, and your decisions should always be based on your own research, your own goals, and your own level of comfort. But understanding inflation, truly understanding it, is one of the most important steps you can take toward protecting your future. And whether inflation rises, falls, or stabilizes in the coming years, the people who stay informed will always be in the strongest position. Because inflation isn't just an economic force, it's a test of awareness, a test of adaptability, a test of long-term thinking. And everyday Americans deserve to know how to face that test head-on, instead of being quietly overwhelmed by a force they were never taught to understand.